weekly market wrap. My guest this week is Adam Sarhan. Adam, welcome.
Thank you.
Hey, Adam, let's talk about the market. It looks like the bull market move might have either taken a pause or is it the end of the story? What's going on out there?
Yeah, it appears that over the last, 2 weeks or so, we've seen a pause in this bull move. The market, I mean, after a big move up, James, we've had the biggest move in 6 months, right? Almost in history, since March all the way up until August. So it's perfectly normal and healthy for the market to pause and digest that move. Now, there's two ways, as we've mentioned before, there's two ways for the market to pause and digest any move. After, a big move up, a stock or a market currency, it doesn't matter. It's all the same stuff. It either goes sideways or it pulls back and retraces some of that move. And what we're seeing now is the latter. We're seeing it pull back a little bit after such a huge move up. And that's perfectly normal and healthy as long as the pullback is somewhat contained in both time and price. You don't want to see a massive violent pullback down 30, 40, 50%. That's not a pullback anymore. That becomes not just a correction, but a possibly, even worse.
Right.
So what we're seeing now is just a normal and healthy pullback into the moving averages, which typically act as support. And the 50-day moving average is the one that everybody tends to follow. And the major indices are all, right around that 50. And if they break it for a day or two, that's okay. I mean, it's not the end of the world, but the technical guys, the chart watchers want to see that 50 hold. And so far the market's doing its best just to pull back into the 50 and then bounce off of it.
Yeah, you bet. Okay, so I think we can pretty much deduce collectively that the coronavirus is in fact getting worse again around the world. In Toronto, they've increased restrictions back down to 10 people maximum gatherings. We've seen the UK is talking about a complete shutdown of the economy again. Israel has gone completely shut down again. What is both the risk and the opportunity in terms of the worst case scenario with the coronavirus pandemic?
Yeah, I mean, it's a great question. So yeah, all of Ontario went, moved back the restrictions like you mentioned, and the hot spots are starting to pick up again. France even spoke about it. So the reality is we're entering flu season for the whole Northern Hemisphere, not just for, one or two areas or cities or countries or whatever the case may be. And what typically happens in the winter is that you see the cold season or flu season or any other type of, ailment to your health increase due to the cold weather, and people tend not to be bundled up or whatever the case may be. So as that happens, you're going to see a proliferation of cases for people that have COVID-like symptoms. And that doesn't necessarily mean they have COVID, but they just don't know. In other words, my neighbor's kid, he's 5 years old and he had a runny nose. Does he have COVID or not have COVID? I mean, the kid has allergies. It's not COVID. But what do? Do you test them? Do you not test them? That kind of kid's 5. I mean, granted, it could happen to anybody. So that put that out there. But it's one of those situations where you don't know. And there's too many unknowns for anyone to say, okay, this is exactly what's going to happen. The good news is with investing and for your money, the decisions you make, you don't have to, anticipate or I guess guess what's going to happen in 6 to 12 months or predict. That's the word I was looking for. You don't have to predict the future. And in fact, you can't predict the future. All you have to do is just interact intelligently with the news and with the market action that's unfolding in real time. And right now, what the market is telling us is the market is priced in that kind of closure or partial closure with this pullback. And also, it's priced in a return to normalcy at some point in the future because we're seeing a lot of good news on the vaccine front. Look at this week alone. I mean, Pfizer's CEO said we're going to have enough vaccines for everyone in the U.S. And, Trump talked about it, so on and so forth. So there is a big question mark about how bad could it get. I'm sure there's going to be isolated cases where they lock down again and it gets really bad. But stepping back, I think we're closer to the end of this than the beginning.
Mm-hmm. Interesting. Okay, so then, the coronavirus stocks, for want of a better categorization, have sold off predominantly over the last couple of months. Is it maybe time to, really start to take a hard look at better exposure to them?
Yeah, it's a great question, James. Let me just clarify for the audience. You mean coronavirus stocks, meaning the stocks that are trying to produce the vaccine, or the work from home stocks that benefit from it? Just to be
Well,
clear.
yeah, within the coronavirus segment, there are a few subcategories. So in all cases, my question pertains to each of those: vaccines, treatments, and work from home stocks.
Yeah, I mean, we've seen a big pullback in a lot of the healthcare stocks. We've seen a big pullback in the biotech stocks. And if you want ETFs that track that, you can look at the XLV for healthcare and the IBB for biotechs. And the corona vaccine related stocks, whether they be Moderna, mRNA, or Pfizer, PFE, or AstraZeneca, or the biotechs, the list goes on and on. You have a situation now where they've been selling off for the last few weeks. And the pullback in the corona vaccine related stocks actually started before the NASDAQ started selling off. The good news is now it appears that it has somewhat bottomed those all those vaccine type stocks. And that could be a leading indicator to suggest that the tech stocks are going to rebound and go higher.
Hmm.
That's the first segment. The second segment, the stay-at-home stocks like Amazon and Peloton and Zoom and so on and so forth, they're in the pullback phase. So what's happening here is that the biotech stocks that are focusing on the vaccines are leading the stay-at-home stocks.
Mm-hmm. Interesting. CNBC's running a headline this morning that suggests the next wave of the global recovery could send commodity prices soaring, and I
Right.
thought that was intriguing because I don't really see what global recovery they're talking about economically. I mean, if they're gauging that by the stock market, then sure, okay, but the stock market and the economy have become so bifurcated by design that
Right.
I sort of wonder where they're coming from with that. Do you share that sentiment that commodity prices could soar in the event of a global recovery?
I agree with you 100% where there's a big disconnect between Main Street and Wall Street. I mean, right now, if you just look at the data, that Wall Street's acting, it's partying like it's 1999, pardon the phrase. And it means that everything is great, the economy's booming, so on and so forth. But when you look at the data from Main Street, that's not quite there. Now, fast forward 3 to 6 months, 12 months, will we recover, assuming that a vaccine comes out and this coronavirus not goes away, like disappears, but it just becomes muted, so to speak, and life gets back to quasi-normal or more normalcy? I think that will lead to or pave the way for a recovery down the road. Now, is that recovery here right now, today? No, it's not. But are we on the path towards a possible recovery? Considering where we were in March, yes, we're much better off. But considering where we were in January or February, or before COVID really struck the US economy or the Canadian economy or even Europe for that matter, we haven't recovered. We're not at pre-COVID levels just yet in the economy.
Right.
But can we get there? I think so, especially if everyone's worried about, COVID, another lockdown like we spoke about earlier. If that doesn't happen, and instead we get a vaccine, then guess what? We can get a recovery and a big boom. You can have a huge sigh of relief. I always like to be optimistic and try to say we're one headline away from a vaccine or from this whole thing going away.
Mhm.
Whether or not we're one headline away, who knows?
Right.
But that's kind of my outlook.
Sure. Do you think that fiscal stimulus is going to be a big part of the government and central bank response to economic weakness in the event of a recovery or in the event of no recovery? I mean, I think that the financial stimulus has kind of run its course, and now all they have left in the tool chest, so to speak, is fiscal stimulus, which would catalyze a lot of infrastructure build out that would consume a lot of commodities.
Absolutely. So if you look at what's happening in the commodity market, you're already seeing a big move in the entire commodity complex. I mean, you can look at lumber prices, you can look at corn, you can look at soybeans, you can look at gold, you can look at copper prices. I mean, these in the last 6 months since March, these moves have been really, really strong. I mean, gold hit an all-time high just recently. So what's happening now is that we are seeing already a lot of money being moved into commodities in anticipation of that recovery. But to your point, which is fantastic, yes, we're coming closer to the election. We are coming closer. There's this whole back and forth on the fiscal side of the stimulus package, which the second round hasn't passed yet. Now, could it pass right before the election? Could we get checks in our mailbox right before election time? I wouldn't be surprised if that happens. Is there ulterior motives? That's beyond the scope of wisdom. But I know all we know is that another set of massive stimulus is coming, and that stimulus will be spent, and that's going to go from the government into the people's pockets right back into the economy in most of the cases, and that's bullish for the Main Street and also bullish for Wall Street.
Hmm. Yeah, I was invited to an investment conference by email this morning. I'm not going to talk about who it is because I was looking for the virtual webinar flavor of
Right.
conference, but these guys are actually throwing an in-person conference in a hotel in New York City, and I'm like
Wow.
thinking, boy, that's a little optimistic and a little bit early for my comfort level, and I politely declined the invitation. But I mean, is this very representative of the attitude in the U.S. relative to Canada, for example? Canada's always got a more conservative approach to pretty much everything, but is this very emblematic of the difference between the attitudes in Canada and the U.S., do you think?
Yeah, I think when was the invitation? If you don't mind me asking, what was it? Was it soon or was it
Yeah, it
next
was
year?
second week of November.
Oh, wow. So yeah, that's definitely aggressive. There's no question. I mean, all my investment conferences for the most part that I was scheduled to attend have all been moved virtually or just postponed to next year. So the fact that these guys are trying to open up again could be a sign of optimism, or they just try to, hey, let's try it. Worst case, we'll just shut it down, or they can just switch it to virtual. But there's a to your point, there is a big difference between the way that Canadians are handling this whole situation and how their economy is responding to it, so on and so forth, and how the US is. If you look at the stimulus from the governments, I mean, the Canadian government has been a lot more aggressive, if you will, in giving the people money to help them during this whole crisis. You've got that CERB, you've got other EI, and you've got all these other stimulus packages where even small businesses have gotten loans where the first 10,000 forgivable. And I think there's other stipulations. I'm not too sure of the details, but there's a lot more. I mean, to my knowledge, anyone that needs money from Canada and they're Canadian and they were working before COVID, they can get a check for about $2,000 a month, and
Yeah.
it's just extended. Right? Is that somewhere around the world? Of
Yeah.
when you look at the U.S., the stimulus checks were a one-time check. Yes, you had unemployment insurance and it was extended and so on and so forth, but $600. You're not talking about, I mean, time, a week, but it comes up. There's only a smaller portion of the population that was actually given the money the way the Canadian government gave their, people, so to speak, money, or their entities, so to speak, money. Now, that doesn't mean one's right or wrong. There's no judgment here. It's just different ways of handling the situation. Now, like you said, you came out stronger, and I have a few companies as well. We've done the same thing both in the US and Canada, come out stronger as well. And that, to your earlier point about why commodities are going up and why stocks are going up, there are some that have been weaker. I mean, I don't own any restaurants, I don't own any hotels, to be honest with you. That's not my space. And I don't own any cruise lines. So the deeply COVID affected areas, I'm not in, but the areas that I am in, thankfully, have not only emerged stronger, we benefited, we survived, but we've come out of this thing stronger already, and it's not even over yet. So I think there's a big segment of the population that is in that situation like we are, where thankfully we've navigated this with, gracefully, and we're emerging, adapting and evolving and doing what's necessary to make sure we can come out stronger, protect our people, and grow the people that work with us and our partners. And that's been a very, very good thing.
Sure. Okay, so circling back now, we were talking earlier about the central bank response to COVID, and the government has really in Canada. I mean, it's interesting in the United States and Canada, the opportunity to stimulate through individual direct payments has become very politicized in both cases. In Canada, the government in power is not a majority government, but it doesn't have to deal with the Senate, Congress to sort of split. So it's able to really use the pandemic as an excuse to essentially buy votes, which is how a lot of us view it, is that like the deficit is just going to be out of control with this, but liberal government doesn't care because they understand fully that, well, if we write checks to the people are going to be very supportive of us in the next election. And that is so true. In the US, the ability to stimulate is the opposite. It's such a politicized hot potato that both of them use it to drive the dagger into the other's back and nothing gets done, which is arguably one of the flaws of the congressional Senate sort of stack. But what about the central banks elsewhere? Like, how is their response contributing to the entire liquidity mix, and how is that affecting our markets?
Yeah, it's a really good question. Just to clarify, the central bank in the US, irrespective of the politics, has been able to really put the pedal to the metal. And that's a big, big, big driver of the last 6 months of stock prices. Yes, the additional that's monetary policy. The fiscal policy is still going back and forth, and the dagger's definitely going on both sides. And other central banks all around the world, including the Canadian Central Bank, ECB, Bank of Japan, all the major central banks for all intents and purposes, or just about all of them, have been super easy money policy. I mean, we've seen since 2008, you've seen a big, massive paradigm shift in central bank policy from what was the old normal, if you will, to the new normal. The new normal is you bring rates down as low as possible. You flood the system with liquidity whenever the market gets in trouble, not the economy, but the market, the stock market for that matter. Let's go, print more money or flood the system, inject more money into the system. And that has been working for all intents and purposes. Now, will the end of the experiment, who knows how this is going to end? I'm of the mindset it's not going to end gracefully, but anything is possible. Other central banks have gone and actually bought stocks, or they've bought ETFs. We've seen the US central bank go in and buy ETFs and other instruments, if you will. The next step is then to buy stocks. So now you're seeing a coordinated central bank policy or effort to stimulate asset prices globally. And the idea is, as long as the stock markets of the world, and even commodity markets for that matter, and real estate prices stay elevated, then the economy, it's gonna be like a magnet where it's up, the asset prices are up here, the economy might be struggling, but it's gonna move up, 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 up until it catches up. Whereas if you have the economy not doing well and asset prices are doing poorly, it's going to drag it down. It's going to have the reverse effect. The economy is going to go down.
Mhm.
So the central banks of the world are like, okay, well, both scenarios are not good, but what's a lesser of two evils? So the better scenario is let's just prop up those asset prices for as long as possible, and then we'll go ahead and help Main Street catches up to it. Because as long as those asset prices stay higher, we're creating an illusion, which is reality, because you can buy and sell stocks at current prices, that everything is okay. And that just creates a positive mindset, and it beats the alternative. If they don't do anything, you go into a great recession, a depression, that deflationary spiral. And then once that kicks in, it's very difficult to do it, to combat. They don't know what to do at that point. So
Sure.
that's the logic, for lack of a better way of explaining it.
Yeah. Okay. So if we step back for a moment and look to the future, I mean, all this fiscal stimulus and monetary stimulus drives asset prices higher. So it causes inventories to rise because productivity and consumption of resources and commodities goes up, resulting in greater inventories, which in a stimulated world, those are just inventories that aren't actually being taken up by the economy. And that's the weakness in that whole thought process, in my view, on the part of central banks, is that, well, if you create a greater and greater inventory of commodities and products that nobody has the room for or the appetite for because they're already overstimulated.
Right.
What does that do for the threat of a deflationary sort of episode in the evolution of the financial system in the nearer term, or maybe the longer term? When's that going to happen?
Yeah, that's the whole point. Nobody knows, right? So it's an excellent point. So yes, you could have a buildup in inventories, but when you look at what inventories are actually being built up under the surface, like you said, with the currencies, excuse me, the COVID stocks are subsectors, the inventories, they're subsectors as well. If you go, you're doing construction, I'm doing some construction, lumber prices are through the roof, and inventory of basic materials is very, very, very sparse. I mean, it's very difficult to find simple materials to build stuff. And I don't mean build houses or big apartment buildings. I mean, just build projects, expansion to the house or decks, or, just basic projects. And what's happening now is that those inventories are really close to zero. That's bullish for stocks like Home Depot, Lowe's, even the ancillary stocks related to housing market, because housing prices have gone up as well. They're one of the asset prices that go up. So the inventories, it depends on what inventories we're looking at. Now, some inventories that aren't selling, those things are just piling up, piling up, piling up. But for the most part, from a practical standpoint, there's a lot of movement going on. And that's why we're seeing asset prices go up. We're seeing not just in one commodity or one area of the economy. We're seeing a broad range of prices going up. Now that could lead to inflation down the road, but for now, it's like the game of musical chairs, right, James? You're in a situation now where everybody's dancing, the music's going, everyone's fine. As long as that continues, everything's gonna be fine. But eventually the music ends, and then when it does, the last person standing, so to speak, is the one that loses. And that's what could happen here again, to answer the question.
Got to keep your eyes on the chairs then.
That's it.
All right, Adam. That was a great, rousing conversation. I enjoyed your participation as usual, and I look forward to speaking to you again next week. Thanks very much for joining me today.
Likewise, thank you for having me. Have a great weekend.
You too. Bye for now.